Okay, hello everybody and welcome to Sustainalytics webinar on navigating the EU Sustainable Finance Action Plan. My name is Emer Toomey. I'm a Director of Client Relations at Sustainalytics and I am the moderator for today's webinar. We are delighted that so many of you can join us today. For those of you who are unfamiliar with who we are and what we do, let me provide a brief overview. So Sustainalytics is a leading global ESG research, ratings and engagement provider. We work with over 700 clients, including many of the world's leading pension funds and investment managers who incorporate ESG and engagement information into their investment processes. Sustainalytics provides a full range of ESG research products and services, including our flagship ESG risk ratings. Additionally, our Sustainable Finance Solutions unit provides benchmarking products for issuers, including green bond second-party opinions. Now, before we begin, I would just like to highlight some housekeeping issues. So you are all currently muted and will remain so for the duration of the webinar, and this is to try and minimize any noise disturbance. We invite you to send any questions you might have about the presentation through to us using the interactive box you see at the bottom of the screen, here highlighted with the number 1. Incidentally, if you have any audio problems during the webinar, you can also inform us of these during using this interactive box as well. If you'd like to minimize this control panel, you can do so by clicking on the arrow at the top of the panel indicated by the number 2. Finally, this webinar is being recorded and a copy of this recording will be sent to all participants in the coming days. So keep an eye on your inboxes. I'm joined today by Kevin Rani, who's a director of our Sustainable Finance Solutions team, Sheila Wattamwar, who's an executive director of our client relations team, and Marcel Leisten-Schneider, Sustainalytics Client Relations Manager. So in a moment, we will present key parts of the action plan and how Sustainalytics can help. The presentation will take approximately 45 minutes and will be followed by a Q&A session thereafter to allow us to finish the webinar at the top of the hour. So without further ado, let me get started on setting the scene. So in recent years, the EU has made clear commitments to international accords such as the Paris Agreement. In many respects, the EU itself has been one of the driving forces behind such initiatives. And on the back of these, therefore, the EU established a high-level expert group, or HLEG, to develop recommendations to drive the EU's sustainable finance strategy. The HLEG was established in 2016, and the focus was on transitioning the EU economy and also in increasing financial market stability by incorporating sustainability-related risks. So the HLEG published a final report at the beginning of 2018, and in this report, 8 key recommendations were given. These included establishing a taxonomy, clarifying investor duties, upgrading disclosure rules, outlining retail requirements, developing standards and labels, and there were also recommendations around sustainable infrastructure and supervisory responsibilities. Building on the final report and the recommendations therein, the EU then developed a 10-point action plan to drive implementation of these recommendations. These were focused around achieving 3 goals. So reorienting capital flows towards a more sustainable economy, mainstreaming sustainability risk management, and fostering transparency and long-termism. The actions, as you can see, are listed on the right-hand side here. So to aid in developing solutions for some of these actions, a technical expert group, or TEG, was also set up in mid-2018, and they were mandated to work on 4 specific areas. Now, work is complete and final reports have been delivered on green bonds, on benchmarks, and on corporate disclosures. With respect to the taxonomy, the TEG has been doing more work on this, and they are continuing to work on it for another few weeks. From our perspective, we have focused in on 5 of these actions as we see these as particularly relevant for us and our clients. These are actions 1, 2, and 5, which are more taxonomy based. So this is establishing a taxonomy, developing standards and labels, and developing sustainability benchmarks, and within that, benchmark disclosure criteria. And then you have actions which are more focused on transparency and disclosure, such as actions 4 and 7. And these are incorporating sustainability when providing investment advice and clarifying duties, particularly around disclosure. And we're going to dig into each of these in turn. So to just start off with, I'm going to just talk about Action 1, the EU taxonomy, which has seen a lot of talk and coverage in recent months. So in terms of the taxonomy, the original aim was to create a technically robust classification system that helped establish what was sustainable and that was applicable to all types of capital allocation. The H-Leg report identified key sustainability goals and also developed a framework. The TEG was then mandated and focused on building out some technical criteria for the taxonomy. It's important to note that the taxonomy itself is not a standard, rather it underpins other parts of the action plan and could be utilised to support the development of the eco-label, for example. The taxonomy, as it stands, has ended up being focused almost entirely on environmental objectives and in particular climate change, so the current definition of sustainability is relatively narrow. So in terms of turning to what the taxonomy actually is, as I mentioned, this is seen first and foremost as a classification tool. It is a list of economic activities with performance criteria and is focused as it stands on 6 environmental objectives. It is also a work in progress. As I mentioned already, the TEG is continuing to build out further criteria, and in addition to this, it can also be built on further in the future. So the taxonomy is a list of activities, and that's really a key point to highlight, that this is a list of activities. It is not a rating of good or bad companies, and nor is it a mandatory list to invest in. It isn't making a financial judgment on the performance of an investment. What it is speaking to purely is the environmental performance. A key principle also of the taxonomy was that it would be flexible, so both to allow it to adapt to different investment styles and criteria would be based on science and industry experience. It would also be dynamic, which would allow it to respond to further developments and also with the ability to add further activities and data in the future. As I mentioned, the taxonomy as it stands has 6 environmental objectives. These are climate change mitigation, climate change adaptation, water and marine resources, circular economy, pollution prevention and control, and protection of healthy ecosystems. Two of these objectives have seen criteria built out thus far, and that's climate change mitigation and climate change adaptation. In terms of activities, for a taxonomy compliant activity, an activity must contribute substantially to one or more of the environmental objectives. It must do no significant harm, to the other objectives. It must comply with minimum social safeguards, and it must comply with the technical screening criteria. As I mentioned, the TEG has built out criteria for both climate change mitigation and adaptation at this point, so I wanted to just take a brief moment to cover these further. With respect to climate change mitigation, these are activities that contribute substantially to the stabilisation of greenhouse gas concentrations. 8 sectors have been identified, and these sectors are either high-emitting sectors or conversely enabling sectors. The TEG has been pretty prescriptive in terms of activity and performance criteria, and the activities that sit under climate change mitigation are either the greening of activities, for example, utilising zero emissions transport, or greening by activities. So this would be the manufacture of wind turbines, for example. When you look then at climate change adaptation, these are activities that substantially contribute to reducing or preventing the negative effects of climate change. Right now, 6 sectors have been identified, but it's likely that more will be coming. With respect to climate change adaptation, a standalone list of activities and quantitative criteria has not been produced, as this is difficult to do, as climate change adaptation is seen as something that is context and geography specific. The TEG instead has taken more of a principles-based qualitative approach. When we talk about adaptation activities, we're talking about either adaptation of, so activities such as a utility company taking on an early warning flood system, or adaptation by. So that would be where a company may be developing the above early warning flood system to help utility companies and others to adapt. And finally, the last point that I would make here is that currently nothing has been passed. So as it stands right now today, this is voluntary. However, 2 main categories of mandatory use are proposed. One is financial market participants when offering investment products marketed as environmentally sustainable. And their requirement is going to be around disclosure more. You are not necessarily obliged to invest in taxonomy compliant decisions or activities. In terms of the other, then it is member states or the EU is the other proposed user. The taxonomy itself is likely to come into force between 2020 and 2022. This date is to be negotiated. So with that, I wanted to just hand over to Kevin Roney because he will talk a little bit more about our perspective on the EU taxonomy and also how Sustainalytics can help. Kevin, are you okay to speak?
Yes, thanks, Emer, and hello, everyone. I'll speak to some challenges that the taxonomy presents and then how Sustainalytics can help. Next slide, please, Emer. So one of the far-reaching features of the EU's the taxonomy's approach is the way in which it applies eligibility criteria, including performance-based criteria, at the activity level. And this graphic here from the taxonomy report illustrates how the technical expert group, or TEG for short, envisions the investor use case involving the assessment of activities per company in order to identify eligible revenues and then aggregating to the portfolio level. Now, with the right data, this is a really strong approach. It has great potential to really move the needle with respect to the consistency and effectiveness of sustainable finance. Clearly, though, at this stage, a central challenge to using the taxonomy is that current disclosure does not support a full and precise assessment of activities against the taxonomy's criteria. There are some cases in which companies report revenues in a manner that lines up with the taxonomy's requirements and enables a straightforward determination of revenues from taxonomy eligible activities, but not many. Indeed, some requirements even involve metrics that are not commonly measured, let alone reported. And the NACE, the EU scheme for the classification of economic activities, is not used in public corporate reporting. So I think that reporting will get there eventually, but it will take a while. And in the meantime, we need to rely on, to some degree, on proxies and estimates. And this is where Sustainalytics can help. So next slide, please, Emer. So we want to emphasize that we're very committed to working with our clients to develop solutions that make good use of raw data that is available and to improve solutions over time. To date, we've mapped our existing research to the current taxonomy requirements and concluded that while our research is by no means a complete match, there are nonetheless elements of it that do relate directly to many of the requirements of the taxonomy, namely the technical screening criteria, where our sustainable products research is very useful. I'll say more about that on the next slide. And also with respect to the do no significant harm criteria and social safeguards, where our company level research on management practices and on controversies can serve well. Next slide, please, Emer. So this slide illustrates how our research can support the 5-step assessment process outlined in the taxonomy report. So the first step, as you can see, is to identify a company's activities that fall within any of the taxonomy categories, and then secondly, to determine which of them meet the technical screening criteria. And here again, our sustainable products research can take investors at least part of the way. This research tracks corporate revenues from products related to 8 environmental themes that we've identified: renewable energy, sustainable water, etc. Our categories link directly to about half of the activities in the taxonomy. And in the next slide, I'll speak to the degree of alignment there. The third step is to apply the do no significant harm criteria, which are designed to ensure that the activity doesn't undermine other EU environmental objectives. In practice, assessing compliance against these criteria will involve a due diligence-like process focused largely on good environmental management and on regulatory compliance, at least where regulations are decent. And indeed, within the EU context, about 70% of the criteria, the do no significant harm criteria, can be met through compliance with EU regulations. For the most part, this process will focus on company level information and assessment. And again, Sustainalytics research can help. We track a variety of relevant environmental management indicators, as well as company involvement in relevant controversies, which, among other things, track incidents of poor management and of non-compliance. The fourth step here is about avoiding violation of social safeguards, meaning ILO labor rights, that may be associated with business activities. And this too will largely be a due diligence process. And again, our research can help as we track corporate management and performance relevant to these safeguards. The final step here is, in this use case, is to take revenues derived from activities that meet the criteria in the taxonomy and calculate what they represent at the portfolio level. One additional note here is that the TEG has indicated its intention to provide additional guidance that would explicitly allow for reliance on good faith estimates in areas in which the data just isn't there, at least during a transition period for the taxonomy. And this will certainly help to increase the usability of the taxonomy despite data gaps. Next slide, please, Emer. So coming back to our sustainable products research, we've carried out a thorough comparison of the definitions and criteria in our framework versus the taxonomy's criteria, and found, not surprisingly, that the degree of alignment varies considerably. In some areas, such as solar and wind, our assessment of a company's involvement is very likely to align with an assessment based on a precise application of the taxonomy criteria. In a number of other areas, such as sustainable agriculture, the criteria underlying our assessment align in some ways, and that assessment can be considered a rough proxy. And then there are some activities that simply are not in our framework, and as I noted earlier, we cover about half of the taxonomy's activities in total. So our sustainable products research will get part of the way. It will need to be used with awareness of its limitations, but again, the TEG is aware that for some time the use of proxies and good faith estimates will be necessary. Next slide, please, Emer. So to summarize, using the taxonomy will require for some time use of proxies and estimates until fuller data becomes available. And our sustainable products research can help in that regard. Our research on environmental management, on relevant controversies can help in both with respect to do no significant harm and with respect to minimum social safeguards. We are looking for opportunities and to better align our research in certain ways with that taxonomy in order to enhance the solutions we can offer. And we also intend to publish guidance documents to support our clients as they use the taxonomy. Okay, so yeah, next slide, please, Emer. So now we turn to action 2, which is about standards and labels. Action 2 is at this point essentially about the creation of a European green bond standard, and in a parallel process, an eco-label for green retail investment products. To date, the priority and our main focus here is the green bond standard, which will be a voluntary standard and label available to green bond issuers. The TEG has proposed that it be comprised of the four components that you see here. The requirements are very similar to the requirements of the green bond principles, with a couple of noteworthy exceptions, which are that use of proceeds criteria in green bond frameworks must be aligned with taxonomy criteria in order to be labeled. And secondly, it will be mandatory to obtain verification by an accredited verifier of a green bond framework and of allocation reporting. With respect to the accreditation process, the TEG has recommended a voluntary interim process for verifiers during a transition period of up to 3 years, after which it's expected that a permanent accreditation scheme will be in place and operated by ESMA. Next slide, please, Emer. So as a leading provider of second-party opinions to green bond issuers, Sustainalytics is, of course, following closely and participating in this process, and we intend to become an accredited verifier. It's clear that in the green bond market, there is a lot of interest in the EU taxonomy and the EU green bond standard. And along with this, there are some concerns about the stringency of some of the thresholds in the taxonomy, as well as the binary nature of the taxonomy, and of course, data availability. And we share some of these concerns, completely understand them, and have articulated similar concerns in our own feedback. Our best guess, though, is that they won't create a constraint in the market. We expect that in practice, there will be flexibility in the use of the taxonomy, such as the possibility of using good faith estimates. And we also expect that in the shorter term, at least, the green bond standard will serve as a supplement to a core assessment of greenness that accompanies, say, what we articulate in our SPOs. And we see a lot of interest from issuers in receiving that a supplemental assessment against the EU Green Bond Standard. And this is something that we intend to offer as an optional add-on to our SPO service. So with that, I will pass it back to you, Emer. Thank you, everyone.
Thank you very much, Kevin. I really appreciate your insights there. I'd now like to ask Sheila Wattermore to come online and speak regarding Action 5, which is all around benchmarks and benchmark requirements. Sheila, are you good to speak?
Great. Hi, everyone. Thank you, Kevin, for the first two sections, and thank you, Emer. In this next section, we'll walk through Action 5 climate benchmarks, as Emer had just mentioned. We realized that while Action 5 focuses more on providing guidance to index providers, it is certainly important for all market participants to understand the scope of this section. I'll first provide an overview. Along with the other action plan areas, the Technical Expert Group, TEG, also looks closely at the role of benchmark providers and how benchmarks can further contribute to the transition of capital into sustainable investments. After a few iterations of the guidance document and collective feedback, the TEG released its final report just this past September 2019, which will actually call for enforcement of action in early 2020. The primary purpose is aimed to provide comparability, investment management tools, an increased amount of transparency, and to disincentivize greenwashing. The action is comprised of two main components. First, the creation of two separate climate change benchmarks, and second, the general ESG disclosures on both ESG and broader benchmarks. Next slide, please, Emer. Diving into each of these in a little bit more detail. The two climate benchmarks called for are the EU Climate Transition Benchmark, or the EU CTB, which is meant to help the transition to a low carbon economy, and the EU Paris Aligned Benchmark, the EU PAB, which is considered to be a climate opportunities benchmark. The primary differences are that the EU CTB looks to create a benchmark that is 30% less emissions than the broader index and has at least an equal amount of green to brown share ratio, while the EU PAB looks to create a benchmark with 50% less emissions than the broader benchmark and a green share to brown share ratio of 4 times, as well as additional exclusionary criteria across some carbon-intensive products. For both benchmarks, it must start considering Scope 3 in relevant sectors within 4 years, preferably sooner, and must continue to reduce carbon footprint by 7% annually. As well, there are certain controversial weapons and societal norm exclusions that must be included. Next slide, please. The second piece of this action is a call to increase ESG disclosures on all benchmarks, with the exception of interest rate and currency benchmarks. While ESG disclosure on non-ESG benchmarks is elective, it is highly encouraged. Notable points here are that disclosure criteria differ between asset classes, but a standard reporting template is to be used by all and made freely available by the benchmark administrator. And benchmark providers must disclose a statement of ESG philosophy, which contains an explanation of how ESG factors are reflected in each benchmark, which means if a provider decides not to report disclosures on non-ESG benchmarks, they must include a statement indicating their lack of ESG considerations. Next slide. This here is just a quick snapshot showing that varying disclosure requirements exist for different asset classes. For example, while all equity and corporate fixed income indices are asked to report on their percent exposure to controversial weapons, sovereign indexes are not. Next slide, please. So brief impressions we have about this action is that there are indeed some key challenges, similar to what Kevin had mentioned in the earlier actions. For example, the accuracy of carbon emission measurement, especially the measurement of Scope 3 emissions, continues to be a challenge. Also, the evolving nature of KPIs as well as ESG methodologies will pose a potential burden on benchmark providers as those continue to update and change. And finally, the additional costs associated with the implementation more generally. However, Sustainalytics can certainly help with some of these challenges by helping through the navigation of these requirements, as well as with our research mapping into most of these needs. Next slide. Upon diving into the needed KPI requirements, Sustainalytics has identified that we currently cover a large portion of what is needed to comply. These exist within the robust breadth of our research products listed on this slide. We'd of course be happy to walk anyone through these research products in more details offline. If we can turn to the next slide. And also, we can help you by mapping our research to the 2 climate benchmark requirements. For instance, when thinking about the green to brown share ratio, it can be calculated using elements of both our sustainable products research as well as our fossil fuel involvement research. And next slide. Finally, looking at the broader disclosure requirements, we can certainly look across our products mentioned before and are able to align with the defined criteria that fall under the overall ESG disclosure category, as well as the environmental, social, and governance disclosure categories. Since there are quite a few categories to go through, if you'd like to learn more about this specific mapping, please feel free to contact us and we'd be happy to help. So with that, I'd be happy to hand it over to Marcel to walk through actions 4 and 7. Thank you.
All right, great. So hi, everyone. I'm now going to focus on the new regulation for investors, mainstream investors, and specialized sustainable investors alike. Emer, can we go to the next slide? Yeah, perfect. Thank you. So question is now, how are investment decision-making processes affected and how do they need to be adjusted in order to comply with the new regulation? Let me start by giving you a brief overview of the 2 relevant actions 4 and 7. Action 4 addresses the end or retail investor perspective and how sustainability preferences have to be part of a suitability assessment going forward. This is being implemented through regulatory bodies such as MiFID II and the Insurance Distribution Directive, IDD. Action 7, in turn, focuses on setting out disclosure requirements for institutional investors and asset managers. This regulation introduces 2 new concepts of sustainability risks and factors, representing the 2 sides of a coin, the shareholder and the stakeholder perspective. This is a major development. For the first time, the integration of sustainability or ESG will become mandatory for every investor and for every investment fund. An important question now is, when is this going to be mandatory? These requirements set out by this regulation have to be applied by the end of next year already. Emer, can we go to the next slide, please? Perfect. So as mentioned, there's new regulation for all types of funds, for mainstream and sustainable investors. So key point is that all funds have new requirements, not just sustainable funds. With these new requirements, all investment decision makers will have to disclose on sustainability risks and factors. A sustainability risk is a potential ESG event or condition with a relevant material effect on financial return. As an example, take the investment in a utilities firm that is exposed to a carbon tax or other regulatory risk. All investors also have to disclose on sustainability factors. Defining features are the effects that companies have on the environment and on society. Take as an example here, a mining company affecting the community and the environment through its operations. In a nutshell, what has to be disclosed are these risks and factors and how they affect shareholder value in the case of risks and how they affect stakeholder value in the case of factors. Going beyond mainstream investors now, what is going to change for specialized ESG or sustainable investors? Regulation introduces 2 new concepts here. On the one hand, we have investments with E&S characteristics. Those promote environmental and social causes as well as good governance. This investment approach follows a broad and more top-down ESG agenda. Just as an investment example, take a diversified portfolio with a clear intention to apply ESG or exclusionary data. Taking it a step further, there's the concept of sustainable investment. These investors ought to contribute to very specific E or S objectives. This approach is more narrow in comparison to the prior E and S characteristics approach, and has much more of a clear focus, as mentioned. As an example, take a fund with a low carbon objective, or they could also be an SDG related objective. This one is quite close to what investors today understand as impact investing. Now the question is what those two concepts, E and S characteristics and sustainable investments, have in common is that the requirement is there to demonstrate and disclose on impact. Emer, can we go to the next slide? So now I'd like to present some more detail on what's going to be relevant for all funds, as mentioned, mainstream and also specialized ESG. Key point is that material ESG risks have to be explicitly integrated into investment decision-making processes. And also the applied approach, as well as the identified risks, have to be disclosed. Regulation doesn't specify or prescribe how to do so. E.g., regulation doesn't specify which risk measurement tool has to be used, at least not for now. However, expectation is that this will become clarified going forward. So while some of this info has to be published on a website, there is also specific info that has to go into pre-contractual documents. On the product level, all relevant and major risks have to be assessed and disclosed. However, the goal is not to disclose all risks, but the major ones. And then also, what's the alleged impact of such risks on investment returns? This has also to be disclosed. As for sustainability factors, this part represents the impact or stakeholder perspective, where investments supposedly have an adverse impact, material or not. This has to be considered and published on a website as well as on a product level. This impact assessment also has to be reported in an ongoing way in the form of reports or fact sheets. Emer, can you go to the next slide? So with this, I'm providing a bit more detail on regulation relevant to specialized sustainability investors. Let me start with investments with E and S characteristics, those that promote environmental or social features. Here, investors have to provide an explanation of how characteristics are met, whether through application of a specific benchmark index or some other measure. This measure has to be in line with the promoted E and S characteristics, though. The second concept then covers sustainable investments, i.e. the promotion of a specific sustainable objective. Main requirement is to provide info on which methodologies are used to measure the impact following a specific investment objective, e.g. low carbon or specific SDG. The regulator expects that for measuring impact, oftentimes benchmarks will be used. In cases where no benchmark is available, provide an explanation on how an objective is obtained. Also note that this is not to be considered a one-off reporting exercise either. Instead, continuous reporting is needed to be in line with regulation. Emer, can you go to the next slide, please? So now the question is, how can we support our clients with meeting these four outlined regulatory concepts? So we have products that allow you to be fully aligned with all of the requirements of the regulation. So be it products such as our risk rating or carbon risk rating being developed with a clear focus on financial materiality in order to tackle sustainability or ESG risks, or be it products that support sustainability factors, i.e. meeting requirements with a clear stakeholder focus. In terms of supporting clients with more of a sustainability focus, we can support you with a variety of products that allow to assess and report on impact or impact alignment. So with this, I would give it back to you, Emer.
Thank you very much, Marcel. Appreciate it. I notice there's a lot of comments and questions that are coming in, so I'd now like to open this to Q&A. So if you want to ask a question, please do send us a message via the boxes as indicated. But yeah, so there's a lot of questions in here. Just to start off with, actually, Marcel, there's one for you, and that is, how is the taxonomy influencing investor disclosure duty requirements?
Yeah, sure. So as mentioned before, the taxonomy is a classification system, so it's not a risk measurement tool. So that's not how it was, set up. In terms of providing information or relevant information to those first two aspects, sustainability risks, for example, the taxonomy will not be able to be applied at all. So something that is being discussed, on the side of people involved in the regulation, there might be some regulation that will influence how sustainable investments will, how the taxonomy will flow into these sustainable investments part that we just covered briefly. But as said, so for mainstream investors which have to disclose on sustainability risks, the taxonomy will not be useful at all, I want to say.
Okay, thank you very much, Marcel. We've quite a few questions actually on the benchmark side. Sheila, if I can just ask, we've spoken about these requirements being for the EU, but how do we see these affecting investors outside of the EU, particularly on the indexing side? So how do we see this as an impact for those beyond just those situated in the European Union?
Sure. I think that indeed, while these guidelines are meant for the EU, investors span the global landscape. And so many of the investors that sit outside of the EU, such as in North America or Asia, still will have to comply to some of these as it relates to the clients that they're serving within those EU markets. I think it's also important to be aware of what's going on, even if your focus is not the EU market, simply because the purpose of this is to allow for that comparability, and therefore I do believe that a lot of companies will start thinking about this, paying more close attention to this, and it will drive a lot of what we're seeing in the market globally.
Okay, thank you very much, Sheila. Marcel, can I actually just go back to you, because we've had a question in here with respect to the MiFID II and IDD. So I've a question here asking whether the suitability and integration and other criteria within MiFID II and IDD, are these actually finalized and in regulation yet?
So those are not finalized yet. So the idea is that they will change going forward, because they have there's this mandate that those have to change, and then they have to integrate what we've discussed, the sustainability preferences of end investors. I do know, though, that there are some suggestions already coming from within various countries in continental Europe. So there are some topics being discussed and some suggestions being made, but there have not been, until now, there's no exact idea of how MiFID II is going to change and when this is going to be finalized. So unfortunately, we can't give a clear date to this, or we can't put a clear date to this for now.
Okay, thank you. Thank you, Marcel. Kevin, if it's okay for me to turn to you, we've had a question in, and it's an interesting one actually, and it is, how many green bonds currently comply with the EU taxonomy? I'm not sure whether you'll have an exact number, but do you have a sense of what that looks like in terms of the current position?
Yeah, it's a great question, and a very difficult question to answer. I mean, one thing to bear in mind is that many green bonds have uses of proceeds that don't relate to the environmental objectives of climate mitigation and adaptation. And so there's presumably a whole set of activities and criteria that will be added to the taxonomy over time that relate to the other objectives, which are the focus again of some uses of proceeds in green bonds in the market. So that would account for some of them, not meeting the requirements of the taxonomy. Another question in the mix here is if we think about it in terms of complying with the letter of the law, so to speak, in the EU taxonomy, then the number of green bond frameworks out there that meet the taxonomy's requirements is going to be pretty low. I would guess it would be a small minority. And the reason there is that the frameworks haven't been designed to speak to or ensure compliance with all of the detailed criteria in, say, in the do no significant harm criteria. They just, the creators of those frameworks just didn't have them in mind. So there isn't a way of verifying or gaining assurance with respect to those criteria. If as I noted earlier, if we are able to move toward an approach that relies in part on good faith estimates, then that will increase the number of bonds out there that do comply. And I think in some areas, like in renewable energy, for example, a lot of the issuance, I'm guessing, would comply based on that approach. But again, it's hard to say beyond that what the number would be.
Okay, thank you very much. And actually, Kevin, on a slightly different note, but this is a question again that I'm going to throw at you. We've had a question. Do you think oil and gas companies will be able to issue green bonds under the taxonomy, for example, targeting activities using biofuels?
Yeah, I mean, anybody can issue a green bond if the use of proceeds, if they use proceeds for taxonomy eligible activities. So yeah, an oil and gas company, if it invests in bioenergy production in a manner that meets the taxonomy's requirements, then that'll be eligible as a green bond. Okay,
thank you. That's really helpful. I'm just scrolling through. There's so many questions being fired in. I've one here, Sheila, if you don't mind turning to you. They say the risk return characteristics of the Paris-aligned benchmark will be very different from regular benchmarks. Will institutional investors really consider investing their money accordingly?
That's a great question, and I think it's a question that yet to or remains to be known when we do speak to our clients or some of the market participants in this benchmark space. That is one of the concerns they have around how realistic are some of these benchmarks. And so indeed, while they'll be able to construct them, and we can certainly at Sustainalytics help them with by providing the appropriate signals to help construct those indexes as to how viable they are and how much they'll be used in the market is yet to be seen.
Okay, thank you. I mean, and that is, I guess, the thing, that a lot of this stuff is work in progress or early stages or just being implemented as well.
Exactly.
Okay, Marcel, another one for you. We just had a question here that in terms of disclosure, are there specific metrics and associated methodologies required for comparability? And I suspect actually that's one that both could be directed both at Marcel and at Sheila. But Marcel, I'll let you go first.
Yeah. So regulation says that investors have to disclose but it doesn't really specify how to do so. So it doesn't tell you like which risk measurement tool has to be used, or so it doesn't prescribe what kind of specific indicators or metrics have to flow into your risk assessment, for example. So my answer would be, so there's no clear metrics, or system of metrics or indicators set out by the regulation. The only thing we know for sure is that you have to disclose on what you do. So it's not a very prescriptive regulation at the moment, but at the same time, obviously, it's quite a large step or a big step because everyone has to disclose.
I would say, I'll just quickly add from the benchmarking piece, there are some more specifications. So while there may not be direct guidance around which methodologies to use. Indeed, within that overall ESG reporting and within each of the E, S, and G buckets, there are quite some specific KPIs that govern what should be reported in each of those, almost in a sense defining the methodology that they're thinking about. Now, from a Sustainalytics perspective, that doesn't necessarily completely align with how we define our, maybe one product versus another. But as I had mentioned, when you look across of our product offerings, we're able to map the various KPIs that are aligned with the specific requirements or recommendations of the benchmarking guidance here.
Okay, thank you. Thanks very much. Appreciate that, Sheila. So there's another one actually, and this is, I think, a really good question. It's one that we've had a conversation on previously, Marcel. So again, back to you. But the impact on, say, a passive manager with, say, 1,000+ companies in a portfolio versus an active manager with a concentrated portfolio. Can you talk about the sort of different impacts and sort of how this will affect them in different ways?
Yeah, sure. So in terms of sustainability risks and factors, investors really have to disclose on entity level as well as on product level. So as it stands right now, it looks like investors, if they have a really large portfolio, they have to provide information on entity level as regards to sustainability risks and factors, I want to say. I'm not sure how practical this is and how this will look in practice, or what is going to be best practice going forward. But as it stands for now, there is this idea, yeah.
Sheila, did you pick up anything else? Because I know that you work a lot with passive investors, and obviously, the benchmarking requirements might actually have an impact there as well.
Sure. Yeah. So especially, I think as it relates to the passive manager, which is heavily dependent on the benchmark or the index provider, I think maybe one of the implications may be cost associated with some of that disclosure, and if that is passed on to that passive manager or not. But I think, again, it's early days to exactly understand that cost implication downstream into the market.
Okay, thank you, Sheila. Thank you very much. There's a question here with respect to green bonds. So Kevin, if I can ask you this one, and it's with respect to on green bonds, if one of the requirements is to do regular reporting, how will the green bond verifications help? As currently you only do this at issuance stage and no one seems to do it at post-issuance reporting. Will there be checks in place?
Yeah, so just to note there, we do provide a service to review reports as well. So annual reporting over time is something that we do for some issuers as an ongoing service. Now, and I assume that, such a service will be required. That's clear from what we've heard from the TEG. Now, the exact requirements of that process of the reviews and what will qualify as verification, we don't know that yet. But that's something we're watching closely, and we intend to sort of position ourselves to be able to carry that out.
Okay, thank you, Kevin. I'm conscious of the time. We've just got a couple of minutes left. I'm just going to throw one last question at you, Marcel. You're getting a lot of them today. But this is, to qualify for sustainable investing, how strict is the requirement of achieving E&S objectives? Where can we find more supporting documentation for how to qualify for this classification?
Yeah, sure. So for one, also the investors that want to follow a more sustainable investment agenda, they have to disclose on sustainability risks and factors. I mean, that's what all investors are going to have in common going forward. Then more specifically in terms of investors focusing on E&S characteristics, and then also we have sustainable investors. So the two categories within more sustainable investing. For E&S, the idea is that this is clearly less strict, I want to say. So as mentioned before, this is a broader investment approach. So it could include some kinds of ESG integration, broader or more top-down. It could also include some exclusions. But we're not too sure. So there's not too much in terms of documentation on what this exactly means, or in terms of how the regulation is going to look at this specifically. But what we do know in terms of sustainable investing, so the more stricter approach, this is really something for investors that might still have a return first focus, but it might also address investors with a more impact first focus. This is definitely going to be more strict. It's more impactish in general. It's very concrete in terms of the pursued objective of this investment approach. The regulation also provides a little more in terms of definition, how they define this. But I mean, what those two investment approaches will have in common is the focus on impact. And I guess I really want to stress that point. So investors that pursue those two investment approaches have to measure, monitor, and disclose on how they think they can measure impact. May it be through a benchmark or some other way to measure this, but this is going to be key, that this is going to be measured, monitored, and then disclosed.
Okay, and also just to be clear, it's less that it's just you need to qualify for sustainable investing. It's more that if you are saying that that's what you are doing, that you have to meet these particular criteria. Is that correct?
Exactly. Yeah, there needs to be this component of intentionality for those investors. Mm-hmm.
Perfect. Okay, I'm aware that there's a few more questions, but I'm also aware that we're almost at the top of the hour. So this will bring us to the end of our presentation. Thank you once again so much to our audience for taking the time out of your busy day to join this session. And thank you very much, Kevin, Sheila, Marcel, for sharing your thoughts with us. We will follow up individually on any questions that we couldn't get to today, because I know there are still a few. If you do have any additional questions, please feel free to email Sheila, Marcel, Kevin, or myself. And finally, as a reminder, a recording of today's session will be shared with everybody in the coming days, so please keep an eye on your inbox. So thank you everyone for joining, and have a wonderful rest of the day.